Today, we will talk about callable, or redeemable, bond types, example, pros and cons. A callable bond, also known as a redeemable bond, is a bond that the issuing company can redeem before the stated maturity date. This allows the company to pay off their debt early. The issuing company might choose to call their bond if market interest rates decrease. This will enable them to borrow money at a more beneficial rate. Callable bonds typically offer a more attractive interest rate to compensate investors for the potential early redemption. A callable bond is a debt instrument where the issuer reserves the right to return the investor's principal and stop interest payments before the maturity date. Corporations may issue callable bonds to fund expansion or to pay off other loans. The bond specifies the terms of when the company may recall the note. Callable bonds typically can be called at a value higher than the par value of the debt. Callable bonds come with many variations. Optional redemption lets an issuer redeem its bonds according to the terms. Sinking fund redemption requires the issuer to adhere to a set schedule while redeeming a portion or all of its debt. Extraordinary redemption lets the issuer call its bonds before maturity if specific events occur. Call protection refers to the period when the bond cannot be called. If market interest rates decline after a corporation floats a bond, the company can issue new debt at a lower interest rate. They can then pay off the earlier callable bond by exercising the call feature. However, the investor might not make out as well as the company when the bond is called. This situation is known as reinvestment risk. Callable bonds may not be appropriate for investors seeking stable income and predictable returns. Callable bonds typically pay a higher coupon or interest rate to investors. However, an issuer will usually call the bond when interest rates fall, exposing the investor to replacing the investment at a lower rate. Companies must offer a higher coupon to attract investors, increasing the overall cost of taking on new projects or expansions. For example, if Apple Incorporated decides to borrow $10 million in the bond market and issues a 6% coupon bond with a maturity date in 5 years, they may decide to redeem the bonds after 3 years if interest rates have fallen. The company would then reissue the bond at a lower interest rate, benefiting from favorable market conditions. Here are 3 key takeaways. 1. A callable bond is a debt security that can be redeemed early by the issuer before its maturity at the issuer's discretion. 2. A callable bond allows companies to pay off their debt early and benefit from favorable interest rate drops. 3. A callable bond benefits the issuer, and so investors of these bonds are compensated with a more attractive interest rate than on otherwise similar non-callable bonds. Hope this would help. Thanks for watching.